This video is for those who are interested in starting their journey into Forex trading this year. This is a step-by-step guide to get started and begin earning money in the fastest and simplest way possible. Let's jump straight into it. 1. What is Forex? And in simple terms, it's basically the process of buying one currency and selling another currency simultaneously. The reason why it's the world's largest financial market is because every single country in the world has to trade internationally. They all have to exchange their currencies. So this means that there's over $7 trillion worth of currency being exchanged every single day. And this is what creates massive opportunities for us to make money. First off, let's start with the definition of what Forex actually is. It stands for foreign exchange. In order to make money, all we need to do is predict whether the value of a certain currency will go up or down compared to another currency. When the exchange rate goes in your favor, you make a profit. And when the exchange rate moves against you, you make a loss. So we can see here on the chart that the higher low of this trend line is around 1.20000, and the next higher low is around 1.22000. You can also open a practice account, which is also known as a demo account. A demo account is an account where you can trade with fake money. This will allow you to trade anywhere on the go. There are also plenty of Forex apps available. You can find these from the Apple App Store or Google Play Store. Some of these might have a paid version, but we don't need these paid versions because they don't teach us anything new. We can use this to practice and test out strategies without risking any real money. Support and resistance are areas where the price has had a hard time breaking through. So if we were to draw a trend line across these areas, it shows us that there is strong support here. So whenever the price drops to this area, it's likely that it will bounce back up. Out of all of these, swing or day trading would be the best option for beginners. Now, if we are able to find another point that is higher than these two lows, then we can connect these 3 points with a trend line like so. This strategy combines the use of the RSI indicator along with moving averages. First, open the chart and click on the Indicators tab. This involves determining the appropriate lot size, setting stop losses, and calculating potential profits and losses. It's important to set a stop loss before entering a trade so that you don't end up losing more money than you can afford. When calculating potential profits and losses, it's important to take into account the pip value of the currency pair you are trading as well as the lot size. You can use a Forex calculator to help you with this. By following these risk management guidelines, you can help to ensure that you don't lose more money than you can afford and that you are prepared for potential losses. Most brokers will offer a demo account where you can practice trading with virtual money. When you're ready to start trading with real money, it's important to start small, especially if you are a beginner. This means that you should start with a small account size that you are comfortable with risking. This can lead to emotional burnout and poor trading decisions. Another mistake is using too much leverage. Leverage is a tool that can be used to increase the size of a trade, but it can also amplify losses. The best trading sessions are typically during the London and New York session overlap. You can use tools to help automate alerts and analysis. Consider joining a community for support and guidance. You can join Telegram groups or Discord servers. Keep learning and stay up to date with the latest trends and strategies. You can use websites like Baby Pips or YouTube channels to learn more about Forex trading. Taking courses can also be a great option. It's important to only use leverage when necessary and to be aware of the risks involved. Let me know in the comments below if you have any questions. Don't forget to subscribe for more trading content. Wishing you the best in your trading journey. A third mistake is ignoring risk management. This can lead to significant losses and financial problems. It's important to always use proper risk management techniques when trading. Finally, copying random signals without understanding them is a huge mistake. Each trader has their own unique strategy, and what works for one trader may not work for another. It's important to develop your own strategy and to understand the risks involved in trading. As you gain experience and confidence, you can gradually increase your account size. This can help you to get comfortable with the trading platform and learn how to use indicators and other trading tools. It's also important to backtest your strategy before using it with real money. This is where you test your strategy on historical data to see how it would have performed. This can help you to identify any flaws in your strategy and make adjustments before risking any real money. When deciding on a lot size, it's important to consider your account balance and the amount of money you can afford to lose. Generally, it's recommended to use a lot size that is no more than 1% of your total account balance. Greed and fear are two emotions that can often get the best of traders, leading to impulsive decisions. It's important to be patient and disciplined and stick to your trading plan. Revenge trading is when a trader makes a series of bad trades and tries to make back their losses by taking a high-risk trade. This is often done impulsively and without a clear trading plan. It's important to avoid revenge trading as it can lead to further losses and emotional burnout. This is showing us a bearish trend in the short term. We also wait for the RSI to be below the 50 line. This is showing us that there is more selling pressure than buying pressure. Once these two conditions are met, we can enter the trade. Then click on the Indicators tab again and type an EMA. So you need to figure out how much money you want to risk and set your stop loss accordingly. Take profit. We can set multiple take profit points depending on our own preferences. One easy method would be to use the 200 EMA as a take profit point. Select the Exponential Moving Average standard option. Next, change the settings to 50 and 200. These represent the 50-day exponential moving average and the 200-day exponential moving average. Once you have added both EMAs, we can now add the RSI indicator. To do this, open the Indicators tab again and type in RSI. Click on the RSI divergence. Change the settings to a 14-day period. Alternatively, you can also use TradingView. Here's how I have set up my TradingView to make things easier for myself. There are also plenty of other tools available. By signal, we wait for the 50 EMA to cross above the 200 EMA. This is showing us a bullish trend in the short term. We also wait for the RSI to be above the 50 line. This is showing us that there is more buying pressure than selling pressure. Once these two conditions are met, we can enter the trade. Technical analysis uses charts and different tools such as indicators, pattern recognition, and candlestick formations to identify areas of support and resistance and determine potential future price movements. On the other hand, fundamental analysis looks at a variety of factors that can affect the price of a currency pair. These include economic data, political events, and interest rates. Both technical and fundamental analysis can be useful when trading Forex. However, technical analysis is generally considered to be more useful for shorter-term trades, while fundamental analysis is better for long-term trades. You can find these from the TradingView website. If the price breaks through this trend line, it's likely that it will continue going upwards. So if we think that the USD, the US dollar will increase in value against the Japanese yen, we can buy the US dollar to Japanese yen pair. Or if we think the opposite, we can sell the same pair and still make money if our prediction is correct. 2. Understanding currency pairs. So currency pairs are what we trade in Forex. These are two currencies that are always traded together. For example, if we want to trade the US dollar against the euro, we'll trade the euro to US dollar pair. If we want to trade the Australian dollar against the New Zealand dollar, we'll trade the AUD/NZD pair. Lot size is the amount of currency that you buy or sell at once. One lot is equal to 100,000 units of the quote currency. So if you open a one-lot position on the euro to US dollar pair, you are opening a position for 100,000 euros. Spread is the difference between the bid and the ask. Leverage is how much money the broker allows you to borrow to open a position. Margin is the initial deposit required to open a leverage position. Now the first currency in each pair is called the quote currency, and the second currency is called the base currency. The bid price is the price that someone can get for the base currency, and the ask price is the price that someone would have to pay for the base currency. 3. Basic Forex terminology. Let's look at some basic terminologies. So a pip is the fourth decimal place after the dot in a quote currency. Now when you are buying and selling currency pairs, the exchange rate is constantly changing. 4. Setting up your Forex tools. First off, you're going to need a reliable Forex broker such as Exness or IC Markets. The next thing you need is either MetaTrader 4 or MetaTrader 5. You can download this from your broker. If you'd prefer to trade on your phone, you can also download the MT4 or MT5 app or the TradingView app. Now when it comes to choosing a trading style, scalping, day trading, swing trading, and position trading, which one is best for beginners? 5. Technical versus fundamental analysis. There are two types of analysis that we can use to help us decide whether the price of a currency pair will go up or down. Some common tools used in technical analysis include RSI, moving averages, MACD, and support and resistance levels. 6. A simple strategy for beginners. Here's a simple strategy that you can use to get started. Next, let's define some rules for our strategy. Sell signal. We wait for the 50 EMA to cross below the 200 EMA. Stop loss. You should never risk more than 1 to 2% per trade. 7. Risk management. This is the amount you are willing to lose on a trade before closing it. Proper risk management is essential for success in Forex trading. Setting a stop loss is also crucial. 8. Trading psychology. Psychology plays a major role in Forex trading. It's important to be aware of your own emotions and how they can affect your trading. 9. Practice first, go live later. It's important to practice and gain experience before trading with real money. Once you have practiced and tested your strategy, it's time to open a live account. 10. Avoid common mistakes. One mistake is overtrading. This is when a trader makes too many trades in a short period of time. 11. Bonus tips for 2025 traders. Here are some bonus tips for those who are looking to start trading in 2025. Thank you so much for watching. Folded hands, I hope this video helped you understand how to get started with Forex trading in 2025. If you found this video helpful, please give it a like, share it with someone who needs it, and don't forget to subscribe for more step-by-step guides, strategies, and financial tips. I'll be posting more content to help you grow your skills and earn online. So hit the bell icon to stay updated. Until next time, stay focused, trade smart, and may your pips always be in profit. Chart increasing with you, and see you in the next video.